Last month, $4.5 billion walked out of America's Bitcoin ETFs. The worst month those funds have had since the day they opened in January of 2024. And not one Bitcoin moved. Not one. The coins sat exactly where they sat the month before, in the same custody accounts, under the same locks. $4.5 billion fled, and the asset it was supposedly fleeing never went anywhere. Almost nobody has stopped to ask how both of those things can be true at the same time. Because the answer tells you something uncomfortable about what you actually own when you buy Bitcoin through a fund. And it explains why, in the same 30 days that money was running for the exit, wallets that have never sold anything in their lives were quietly filling up. Somebody was on the other side of that trade. Every single coin. And they were not panicking. Here are the numbers, and I want you to hold on to them, because the headlines got the story exactly backwards. June 2026, $4,509,000,000 in net outflows from US spot Bitcoin ETFs. I pulled that off Farside's daily table myself, day by day, and added it up. Worst month on record. It beat the old record, 3.5 billion, set in February of 2025, and it wasn't close. 18 of the 21 trading days that month were negative. The worst single day, June 25th, took $691 million out the door in one session. And stretch back a little further. From May 15th to June 3rd, those funds posted 13 straight trading days of outflows. Longest streak that has ever happened. $4.36 billion in 13 days in a row. Now here's the number nobody put in a headline. Of that 4.5 billion that left in June, 3.5 billion came out of one fund, BlackRock's IBIT. 79% of the entire bleed came out of Larry Fink's own product. Hold on to that. It matters in about 6 minutes. That is not a bad patch. That is a stampede. Now here's the part that should stop you. The financial press ran that number as investors are dumping Bitcoin. That sentence is wrong. Not spun, mechanically wrong. Because when you sell your shares in a Bitcoin ETF, you are not selling Bitcoin. You never had any. Think about a coat check. You hand the man your coat, he hands you a paper ticket. Now you're walking around the party holding a ticket, and the coat is hanging on a rack in a back room you have never seen. The ticket is not the coat. The ticket is a promise about the coat. That is what a Bitcoin ETF share is. When you buy IBIT, you are not buying Bitcoin. You are buying a share of a trust that holds Bitcoin on your behalf. The actual coins sit with Coinbase Custody Trust Company. That's in BlackRock's own filing. It's not a conspiracy. It's page 1 of the prospectus. So when $4.5 billion left in June, what really happened is that a lot of people handed their tickets back. The Bitcoin, the real Bitcoin, did not go anywhere. It changed hands on a ledger and sat right back down. And I want to be fair here, because credibility is the only thing I've got. IBIT holds real Bitcoin, real spot Bitcoin, not futures. That's a genuinely better product than what came before it. The coins exist, but the coins are not yours. You own shares in a trust. The Bitcoin is real, your control over it is not. That distinction sounds like a technicality right up until the day it isn't. And by the way, the live Bitcoin price I'm working from, the one I check every morning before I say a word on this channel, isn't a delayed ETF quote off a finance app. It's the actual spot number on a dashboard I built for myself. I'll show you where in a minute. So who took the other side? This is where the story gets good, because the blockchain does not have a press office. It just records what happened. There is a category of wallet that on-chain analysts call an accumulation address. The definition is strict on purpose. It has to hold a real amount of Bitcoin, it has to have never sent Bitcoin out, not once, and it can't belong to an exchange or a miner. In plain English, a wallet that only ever buys and has never once sold. In the first 10 days of January this year, those wallets went from holding about 230,000 Bitcoin to 370,000 Bitcoin. 140,000 coins absorbed in a week and a half. On February 6th, a single day, 66,940 Bitcoin moved into accumulation addresses, a one-day record. Across one 30-day stretch this spring, large wallets took in roughly 270,000 Bitcoin, the biggest monthly accumulation since 2013. And on July 2nd, Glassnode reported that long-term holders, wallets that haven't moved a coin in over 155 days, had flipped from net selling back to net buying. They're accumulating again, right now, at these prices. Meanwhile, 78% of all the Bitcoin in existence is sitting in long-term holder wallets. Nearly 49,000 coins came off exchanges in 30 days. Now, let me be straight with you about one thing, because somebody in the comments is going to bring it up, and they'll be right. The big wallet bucket that gets quoted in headlines mixes two very different animals. Anything over 10,000 Bitcoin isn't a whale. It's a custodian. It's an exchange. It might literally be the ETF. So some of that accumulation is just plumbing. The honest cohort is the one holding between 1,000 and 10,000 Bitcoin. Individuals, funds, people with names and convictions. And that cohort has been buying all year. There's one more reading, and it's the one that turns this from a story into evidence. It's called SOPR, Spent Output Profit Ratio. It sounds like homework. It isn't. All it does is compare what a coin is worth the moment somebody moves it against what they paid for it. Above 1, the average person selling is taking a profit. Below 1, the average person selling is taking a loss. It's been below 1. Read that plainly. Through this entire drawdown, the average Bitcoin that changed hands was sold by somebody eating a loss to get out. And every one of those coins was bought by somebody willing to take it. That is not a market crashing. That is a market transferring. You don't need a conspiracy theory to explain June. You don't need a cabal or a secret meeting. You need one sentence. Frightened money sold to patient money at a discount, and the ledger wrote it all down. Which brings us to the man who just went on television and told everyone the scary part was over. July 15th, CNBC, the morning BlackRock reported earnings. Larry Fink, who runs the largest asset manager on the planet, said this: "There is no question, as I said in earlier times, that I was always worried about the leveraging in Bitcoin and crypto. There were too many leveraged players in it. That's why we had the washout. And I think there's more stability at these levels here." Listen to the tense. Was worried. Past tense. The man who spent years calling Bitcoin an index of money laundering just stood on live television and declared the problem finished. That is not a mood. That's a diagnosis. And it's a sentence an investment committee at a $50 billion pension fund can paste into a board memo. Bitcoin might go up never clears compliance. The CEO of BlackRock says the structural risk is resolved does. The day before he said it, IBIT took in $138.9 million in a single session. And now go back and pick up that number I asked you to hold. 79% of June's bleed came out of his fund. He watched $3.5 billion walk out of the product with his name on it. And 4 weeks later, he stood on television and called the thing that caused it finished. Here's what happened next. And I want to be careful, because it's only 2 weeks of data. July has gone net positive. Through July 17th, the same funds that hemorrhaged $4.5 billion in June have taken in $200 million. And the 4 sessions running from July 14th, the day before Fink spoke, and the 3 days after were all inflows. So, retail hands the ticket back at a loss in June. Larry Fink announces the all clear in July. And the money starts walking back in the front door within days. You have watched this movie before. You watched it in 2009 with houses. But here's the thing about Fink that almost nobody says out loud, and it is the entire reason I'm making this video. Before I get there, that live Bitcoin price, the real spot number, not a delayed quote. It's on the macro command center I built at timtalksfinance.com/members. Free account, no credit card. Same screen I use every morning to find these stories. Larry Fink is not building a Bitcoin company. Bitcoin is his on-ramp. It is not his destination. He has said this himself, repeatedly, in public, for years. He wants to tokenize every asset class: stocks, bonds, private credit, real estate, your house, your savings, all of it, moved onto digital rails, settling in seconds. And the exact same infrastructure that warehouses Bitcoin inside IBIT, the custody, the plumbing, the ledger, is the infrastructure being built to tokenize everything else. So here's the question that decides your retirement, and I want you to actually sit with it. When they finish moving the entire world onto those rails, which asset has no issuer? Because a tokenized bond has an issuer. Somebody can print another one. A tokenized share has a company. They can issue more. A tokenized house has a registry, and the registry has a clerk, and the clerk answers to somebody. A stablecoin has a corporation with a mint button. A central bank digital dollar has a central bank. Unlimited supply, plus a record of everything you buy, plus the ability to decide what you're allowed to buy at all. Every single one of them has a man who can make more of it. Bitcoin has no man. 21 million. Fixed. Forever. There is no committee, no boardroom, no emergency session that can vote another one into existence. No servers to seize, only a protocol running on tens of thousands of machines that don't know each other and don't need to. That is the whole argument. That's it. That is the entire case, and it has never depended on the price. And notice what June did to it. Absolutely nothing. $4.5 billion of tickets got handed back, and the supply schedule didn't blink. 21 million on the 1st of June, 21 million on the 30th, 21 million today. Try that with the dollar. Now I'm going to do something most people in this space won't, because you deserve the whole picture and not just the flattering half. Bitcoin could go lower from here, meaningfully lower. Bitcoin topped at $126,296 on October 6th of last year. Today, it's around 64,500. That's down about 49%. If the 4-year cycle still holds, and plenty of serious people argue the ETFs broke it, then the previous cycle bottoms ran 75 to 85% below the peak. Run that math from 126,000 and you get somewhere between $19,000 and $32,000. We're only down 49%. Willy Woo's framework puts the turn in the back half of this year and real recovery in 2027. I'm not telling you that to scare you. I'm telling you because I refuse to hand you only the numbers that make me look smart. There are no certainties here, only probabilities. And here's what's strange. That bear case doesn't weaken the argument. It sharpens it. Because if you're buying a lottery ticket, a 50% drawdown is a catastrophe. If you're buying the one asset in the world that nobody can print more of, a 50% drawdown is a price. Which is exactly why I'd say this next part to my own brother. Do not borrow money to buy Bitcoin. Do not use leverage. Larry Fink's own diagnosis of the crash you'd be buying into was too many leveraged players. Borrowing to buy puts you on the exact side of the trade that just got liquidated, and the margin call always comes at the bottom, on the day you'd most want to be buying instead of selling. Buy what you can afford to watch fall to 30,000 and still sleep. That's not timidity. That's the only position that survives long enough to be right. So here's where June leaves us. The worst month in the history of the Bitcoin ETFs. $4.5 billion of tickets handed back at a loss. And on the other side of every one of those trades, a wallet that has never sold anything taking delivery. The people who sold owned a promise. The people who bought own the asset. And the man building the machine that tokenizes the rest of your life just went on television and told you the dangerous part is behind us. Right before the institutions he serves started walking in. I'm not going to tell you what to do. That has never been this channel's job. You've had people telling you what to do your entire life, and look where that got the dollar in your pocket. What I'll do is hand you the math and the mechanism and get out of your way. 21 million. Fixed. No issuer, no man who can make more. In a world where every other asset you own is about to be tokenized by somebody who can, you know what to do with that. Free, no credit card, about 2 minutes. The Macro Command Center at timtalksfinance.com/members. Live Bitcoin and gold prices, the same screen I use, plus the money quiz that shows you in real dollars what inflation is quietly costing your cash every year. I built it so you don't have to figure this out alone. I'll see you in the next one.